Insurance is about protection. So why do people even talk about savings and investing along with it? Welcome to the Insurance Playbook, your go-to series for decoding finance, protection, and everything in between. In today's episode, we're diving deep into the world of savings and investments. To guide us through this, we're joined by Mr. Prasun Gajri. He's the Chief Investment Officer and Chief Strategy Officer at HDFC Life. With years of experience and expertise in investment strategy, balancing life cover with long-term wealth creation, and helping you make informed, goal-driven choices for your future. Prasun, thanks so much for joining us today.
Thank you so much for that.
Prasun, 30 years in the entire industry. You've seen it all, honestly. So I want to get a perspective from you. How do you view India as a market for investments, for investors?
Oh, absolutely one of the best. And I'll give you my reasons for it. See, let's start with what we always talk about. India is a young country. Demographics are in our favor. We are one of the fastest growing large economies for a number of years. And where the world is today, given the macroeconomic situation, I don't see that changing in a hurry. So we'll continue to be growing. We are still a very young nation. So that is one part. Second part is there is an intent to turn India into a more developed country. Obviously, we have a Viksit Bharat by 2047. The policy regime has been steady, stable, and improving. So that gives the second part. Now you come to it, what are the other factors which make India a very attractive investment destination? For an investment destination to be attractive, you need 2-3 things. One, you require robust capital markets and financial system, fairly transparent and well-regulated markets, and availability of different avenues to invest. If you compare India on any of these parameters with any country today, I think we have one of the most robust financial sectors in the world today. Very well developed capital markets, deep, liquid, and you combine this with the inherent strengths of being a young economy, growing economy, policy stability, intent to kind of keep growing faster, I think just makes it an unbeatable combination for us. So as we see the per capita incomes increasing in India, I think there'll be more money to invest in India, both by the Indians, and obviously the foreign money, while there are phases when it comes and goes, but today I think the domestic money is becoming far more important. And put all this together, I mean, there is absolutely no reason to believe that India is not an attractive market. It is the attractive market, and I would say it is one of the most attractive markets in the world from an investment point of view.
Of course, our topic is around life insurance.
Right.
And, when we say life insurance, we think of protection, we think of security. But many forget that it could also be an investment avenue. So if you could shed some light on that, how is life insurance, or what is the role that life insurance plays in an investment portfolio?
Okay, first of all, let me just start by saying that while life insurance stands for protection, protection is the absolutely vital part of one's investment portfolio. And why I say so? See, when you're trying to invest, you are both trying to kind of make better returns over a period of time, but at the same time, you're also trying to manage the risks you are taking, right? And the biggest risk in life is some eventuality which you're not prepared for.
Yeah.
So protection is easily the most important part of any investment plan in my view. Life insurance provides varieties of different long-term investment plans. Now, you could look at it two ways. One is how these plans are constructed, and we'll discuss that. Second is these plans can also be looked at from a life stage point of view or a goal point of view, whether you're trying to save for your retirement, whether you're trying to save for your children's education, whether you're looking for some money to come back to you over a period of time, whether you're wanting to invest money for your post your retirement and therefore start getting some monthly cash flows back into it. Life insurance companies today provide solutions for each of these things through different kind of plans, and we can discuss those plans. And they come under different categories, which in our technical parlance we call what we call participating plans. We call them non-participating plans, and obviously the ULIPs. And then we have our annuity portfolio, which is meant for people who are post-retirement. So we can discuss each of these in detail, but yeah, so insurance companies are, and good part about these plans is they suit the risk appetite of every individual. So I think that kind of sums up the offering any life insurance company in India today provides to any potential customer.
So perhaps when you even kickstart your investment journey, the first step should be actually buying protection. That's a life
Absolutely.
insurance plan. Then you
Absolutely.
go on to buy different kind of products for growth, wealth, or investment, etc. You spoke a little bit about the kinds of plans that are available. So I'll leave it to you as to how you want to divide it. But give our
Okay.
viewers a glimpse into what sort of plans are there.
Okay, so let's kind of keep it simple. Say, whenever you're trying to invest, the normal notion is that, okay, when I'm investing, I should maximize my return. So, how much risk are you willing to take with that money? Answer is pretty much zero.
Zero, yeah.
Right? If I'm, and this I'm talking about, and let's talk about a very high net worth individual. You have millions of dollars, and your aim is to ensure that you preserve your wealth. Right? You are not here to double the money in 2 years' time.
Yeah.
What is the risk appetite for that kind of money? Very limited, low. So effectively, pretty much someone who's trying to pay an EMI and making that happen, or an HNI who has a lot of wealth already, they're not here trying to maximize their returns, right? So effectively, each of them has an objective. Now, this objective is what we call in simple terms a goal. Right? You're trying to invest because you want to meet a certain level of goal. Okay. Whatever that goal is for you. Now, if my goal is after 30 years, I want to have a good retirement corpus, fair enough, that is the goal. If my goal is, oh, I'm going to retire in 5 years' time, how do I manage my asset allocation? What risk am I willing to take? So each of these are individual goals. Yeah. So therefore, when someone is investing, I think the objective or the goal comes first, and then you try and decide what kind of risk is amenable for that. So first of all, for anyone who's looking to invest, I think one has to be very clear in their mind, why are they investing? Once you have decided why you're investing, then you can get down to breaking it down into, okay, if I have to do this, what is my risk appetite? What kind of, therefore, if this is my risk appetite, what kind of investments match with this risk appetite? And as life insurers today, we provide investment avenues for pretty much all kind of goals. I think that is the way I leave it, and then we can get down to each of those components, which are the solutions insurance companies give, and that will get a little bit more technical. But yeah, I think that is the broad thing. You decide what you want, which goal are you trying to solve for, and we have a solution ready for you.
When we look at life insurance, there are savings plans and then there are investment plans. I think that's the parlance that we have come to hear of very frequently and very often when it comes to insurance. So maybe let's start with that, about the differences between these kinds of plans.
Okay, one, this balance is not necessarily very accurate. Let's be fair on that. See, to me, and I'll explain my difference between savings and investments. Savings is when you park money aside.
Correct.
I mean, that's as simple as that. You earn 100 rupees, you're spending 80, you're keeping 20 aside, that's my saving.
Yeah.
What you do with that savings is when you invest, right? And that 20 rupees, when it's invested, that has to be goal-based. Now, from an insurance company's point of view, we offer, let's say broadly, 4 kind of investment avenues today. So if you want absolutely fixed level of return, absolute guarantee in terms of this is what I'm going to give you, this is what I would expect to get from you with absolute certainty at what time period, we have a plan for that, and those plans are called guaranteed plans, what we pretty much which is almost the nomenclature which the entire market follows. So those are the kind of plans where we are guaranteeing the returns, right? And those are, in our parlance, those are called non-participating products. So these non-participating products have the customer giving us money over a particular period of time at a particular frequency, and then we pay out the customer in different forms and shapes. And customer can pick up whether they want a lump sum at the end, whether they want it divided into various buckets, how much they want to defer it, etc. So a lot of flexibility around how the cash flows can be structured.
So the customer can design it as
exactly in a way, yes. Obviously, so here these plans, the customer knows on day one what they are going to get.
Okay.
So in our view, these are the kind of plans which we believe everyone, I mean, each one of us requires a certain part of the portfolio which has virtually complete guarantee that this is going to come to me. And these plans are very long-term guarantees. See, these are not like 3 years. I can give you a 20-year guarantee here.
Okay.
Right? I can give you a 25-year guarantee. The payment can be happening, say, you give me money for 5 years, then I pay you back for the next 12 years, 13 years, whatever. Okay. So different structures are possible here. So effectively, very long-term guarantees and absolutely guaranteed cash flows, non-participating products. In my view, while you'll say this is for risk-averse investors. In my view, this fits into the portfolio of every investor. You don't need to put all your eggs in a basket where it's all in risky investments. Certain part of the portfolio can go into these kind of investments. Then we come to, okay, a customer says, okay, I'm fine. I'll put part of my money here. Is there something where I can get exposure to markets, but I don't want to be fully exposed to markets?
Yeah.
Okay, so we have plans for that, what we call in our parlance participating plans.
Okay.
So these are the plans which invest pretty much across fixed income, and a part of it is in equities, whereby we pay regular bonuses to the customer. So what you hear in parlance, say prior to, in everyone's mind there is this, insurance companies pay bonuses, right?
Yeah.
So these bonuses are primarily for these participating products, whereby based on the returns earned on the pool of money which is there with us, a certain return is shared with the customer end of the year. So these are called what we call the reversionary bonuses. Once we have declared that bonus, that becomes a guarantee for the customer. And then typically these plans have a bonus at the end, what we call the terminal bonus. Right? So effectively you are giving them bonuses every year and a terminal bonus, and these bonuses depend on the underlying asset allocation and what returns that eventually makes. The underlying asset allocation is basically a mix of fixed income and equity, while our non-participating with the guaranteed is largely more fixed income given the guarantee. So here you will get lower guarantees very clearly, because once the bonus is given, it's a guarantee for you, and there can be other cash flows which can be guaranteed here, but the overall returns may turn out to be higher over a period of time because the asset allocation here is different. So this again suits a certain category of customer. But then you may come to me and say, okay, again these plans, to come back to this again can be customized in terms of tenor type, how much frequency at what you want to pay the premium, how long you want to pay, etc., etc. So eventually it all boils down to what is your need and requirement. Our job at HDFC Life is to provide you the options to be able to choose from whatever your appetite is. I think that is the second part. Third part is, it's not you have done it and you forget about it, right? Like any good investment, I think the notion is you always should track it. That does not mean you need to necessarily keep making changes. Tracking does not mean any action needs to happen. But I think it's good to kind of keep a track of your portfolio on an ongoing basis, not just from the point of view of market movements. Your own life situation may change. You may be in a situation to add more to the investment. You may want to change your asset allocation today. You may want to add a different kind of a product to what you have done in the past. So I think portfolio monitoring is very important. So I think that is the third part. And the final part, in my view, in this entire scheme of things, is stick for the long run. People just don't understand what magic compounding can do for you. I think that is something which is very, I get surprised sometimes. You do compounding over 15, 20 years.
Yeah, and I'm sure in your 30-year journey, you yourself must have seen so many ups and downs in the markets. Absolutely. And you've seen it all, basically.
Yeah, everyone has, and that's the whole point, right? And you look at any data, you can pick up any data point and say, okay, if I were invested, I started this year, I was invested for 3 years, 5 years, 10 years, 15 years, 20 years. What is the probability of me losing money? And you see that if you go beyond a certain period of time, your probability of losing money goes down to 0. Right? But if you have a shorter period, your probability of losing money is higher.
In the last couple of years, we have seen regulations around the insurance industry change and evolve a lot. And naturally so, because Indians as well, like you mentioned, our per capita income is increasing. Our demand for financial products is also increasing. So what have you seen in terms of how regulations are evolving? How customer friendly have they become? If you could shed some light on that.
Well, absolutely. I think regulations have evolved significantly over the last 15, 20 years. And let me say, HDFC Life completes 25 years this year. And since the time we started to where we are today, I think we have seen a sea change in terms of where we were to where we are. And the latest one being GST being removed from insurance products. Now, this is a huge one. From a customer perspective, that has made some of the insurance products much, much cheaper than what they were. And therefore, we believe this is something which is extremely, extremely important thing the government has done. So, though while this is not a step taken by a regulator. This is from a taxation perspective. The regulator has also done a number of things in terms of making it easier, ULIP regulations being a part of it, where the regulations are absolutely clear in terms of what kind of charge extraction is possible, what charges need to be told to the, what has to be told to the customer, what needs to come out in your declarations, etc., etc. So all those are very clearly specified by the regulator. Now the way I look at it is, if I take all this together, and you look at when the government talks about insurance for all, by along with the Viksit Bharat theme, right? I think we one of the few sectors which are probably the only sector in my view where the government is actually talking about this as something which is the aim of the government to make insurance pretty much something which every Indian has, right? So that gives us a lot of, I mean, it makes us very positive in terms of this industry as we go along, and we believe some of these regulations and these tax changes are going to be very, very positive for the overall growth of the industry over the next 5, 10 years, 15 years.
So like coordinated efforts, right? The insurance companies, the IRDAI, and now even the government, they are all coordinating to make insurance very customer friendly. So how should the customer take advantage of this?
I think 2, 3 things here. One, I think customers are already doing that to an extent. But I think there has to be, I think both insurance companies and customers need to kind of get into where insurance companies need to make it simpler for the customer to understand a few things. Customer has to spend some time in terms of understanding their own requirements and why insurance really fits into their scheme of things. As we have seen over the last few years, I think the awareness is only increasing. We didn't really talk about, for example, annuities. So that is one part where it has seen a large traction. We are starting to see more focus on protection and pure protection, where customers are starting to kind of look at that as something very, very important from their overall portfolio point of view.
So what's your investment mantra? I mean, is there a certain set rule book or a philosophy? I'm sure that keeps evolving as you also keep learning.
I think pretty much what I talked about. So I think being in the industry helped me start early.
Yeah.
So I've been investing since the first day of my job when I got my first check. So from that day onwards, I started putting some money, not just as in the saving account, but actually investing. I have never, whatever I'm investing on a monthly basis, I've only increased the amounts as my financial capacity increased. I have never sold a single penny out of it, whatever is my long-term pool. Same applies. So I have adequate protection, which I built on top of my portfolio. I have the guaranteed products, which I talked about as a component of my portfolio. As I kind of getting closer to the fag end of my career, my asset allocation has changed. I have therefore a well-diversified portfolio, a little bit of guaranteed products, some longer-term fixed income instruments, so that it becomes a more balanced portfolio. 10 years back, it was slightly different. Okay. So I think that is what it is. So my own lesson is, and it's not that I have not been tempted to kind of sell down, and a lot of times you just have that urge, this market is really going to fall, and you feel you know it, others don't know it, and you want to kind of say, okay, can I sell 30% of my portfolio and sit on cash? Thankfully, I didn't do that, and I'll tell you the reason for that. It's sometimes easy to time one part of the market. You can exit, for example, but will I always be able to kind of get back into the market in time to be able to take advantage of it? My understanding is no. So therefore, I found staying disciplined and being invested for the long term to be the simplest yet the most difficult mantra.
I think there's that saying, right? If you claim you know what the markets are going to do, you're either God or you're lying. So I think
maybe
maybe
there are people. So I'm not saying there could be someone who's able to do it on a consistent manner. So I may be able to do it once, but can I do it consistently over every cycle? I don't know. I mean, at least I can't. I really can't comment on others.
Okay, let's talk about HDFC Life's investment strategy, because you're dealing with so many customers and they all have their desired outcomes and goals that they want to achieve. So what sort of strategy do you deploy to ensure that the customer gets their desired outcome?
So 2, 3 things here. So I think the first part, what I said applies to individuals, applies to us as well. What is my objective when I'm investing, right? So if I'm investing for the guaranteed product we talked about, I have a certain objective. I have to pay that guarantee. Come hell or high weather, it is the money I have to pay back to my customer. That's my liability. So I have to ensure that the day the money has to be paid, it should be available. There should be no risk in it. So therefore, that is the objective, and therefore my asset allocation, the way I invest, etc., Similarly, on participating products, it's a mix of equity and fixed income. So what kind of bonuses we are giving, what is the terminal bonus which we want to give, etc., will determine where my asset allocation is. It's again not maximizing my return, but investing based on the objective I have. Now, if you look at all this together, I think the key objectives which we tend to follow, one is have a robust process around each of these, because when you're managing large amount of money, it cannot be left to just day-to-day stuff. It has to be fairly well defined as a process. Number two, you need to have a certain mantra in terms of what kind of investments will you make, how do you look at investments. Do you look at investments which will make you return over the next 3 months? Do you look at investments which will make you return over the next 3 years? Are you invested more in stocks which can compound over a longer period of time? Are you invested in stocks which will have a certain turnaround situation and give you a lot of return in the short term? Our focus is more consistent longer term performance, and therefore our portfolio gets aligned to that, which at times could mean that you miss out on some of the market favorites which move up suddenly, but that is it. I mean, that you can't have it all. So idea is to have process driven, have a longer term focus, remain disciplined, and invest as per the underlying objective and not deviate from it at any point of time. I think that is important, and have adequate risk controls around each of the processes you're running. So I think that is the way we want to really manage it at HDFC Life.
Well, that was Prasun Gajri sharing his invaluable insights with us. To all of our viewers, we hope this conversation has helped you gain the much needed clarity on savings, investments, and inspired you to plan your financial journey more confidently. For more such conversations and expert perspectives, keep watching the Insurance Playbook and follow HDFC Life on our social pages for regular updates on all things insurance and investment.